Okay, so welcome everyone, Happy New Year. We stopped the last time right in the middle of our discussion of risk management, and we have talked a lot about the different types of risks a bank is exposed to. You should know by now that there are three main types of risk banks usually are exposed to. Credit risk, obviously, from lending. You face the risk that your borrowers default. The second type of risk is market risk. You trade in financial instruments. You have currency risk. You have maybe sometimes you have commodity risk. And last but not least, since Basel II regulation, we also distinguish the third type, which is operational risk. In fact, anything else that is not credit risk or market risk, and the result is what we call operational risk. Now let's talk a little bit about the basics of risk measurement. Identifying the risk is one thing. We need to measure those risks that we've identified. And in almost all of financial risk management, it's always about statistical loss distributions. And more precisely, sometimes we just talk about loss distributions or P&L distributions, or just P&L. P&L stands for profits and losses. It depends on whether you're also interested in modeling your profits, or in some cases you only concentrate on the potential losses. This is also closely connected to what you do in insurance mathematics, because in actuarial mathematics, insurance companies, if you sell, for example, car insurance, you cannot get a profit out of that contract. The best case scenario is no accident, no loss. So you concentrate on those losses, and that's what you also do sometimes in banking. Why concentrate on financial losses? First of all, it's about money. We can talk about reputational risk, we can talk about effects on reputation and strategic errors, but in the end, we have to come up with a monetary figure, something that is expressed in dollars or in euros, for example. Risk management itself is about limiting losses. It's not about making the right strategic decisions for your business. Again, my best example is the sausage vendor on High Street. He doesn't need risk management. If he chooses this type of business, is not exposed to any risks, and on the other hand, anything that is strategic and concerning your business model, that is left to management and not to risk management. So losses are the focus of financial risk management. We want to prevent financial losses, so let's focus on financial losses and model those with the help of statistics. Then we can use distributions and distributional models from statistics, and based on those distributional models, we'll take some certain moments that provide us with monetary figures, monetary indicators of risk. For example, an expected loss of 5 million, or a certain quantile of the distribution. Loss distributions, in contrast to some other figures or some other metrics you could use, they can be grouped together. They can be summed up, they can be they can be grouped and mixed into each other, and they can be aggregated at each level. At the group level, at the portfolio level, at the investment asset class level, and so on. You can also include netting and diversification effects when using diversifications. We will not see this here, but if you continue to the master's level, there are some lectures that will talk more in detail about quantitative risk modeling, and then you can see how those diversification effects can be included in your distributional model. And loss distributions can be compared with each other, just like you can compare two statistical distributions. Loss distributions as well can be compared. However, you have two disadvantages when it comes to risk modeling using distributions. First of all, you can assume a lot. You can assume your losses to be normally distributed. You can assume them to be Stevens T distributed. That's fine, but that doesn't have to reflect reality. In order for your statistical model to reflect reality, you need historical data to calibrate that model. And whenever you use historical data, It might be that you don't have enough data. It might be that you cannot forecast into the future using historical data, so you will have some statistical error. And in addition, even if you have data, even if you have appropriate data, you need to select a statistical model for your distribution. And if you select the wrong model, you get what we call model risk. Model risk is simply the risk that you choose the wrong data, you choose the wrong model, you choose the correct amount of data, the correct sample, the correct model, but you're just too dumb to apply the data to your model, or you oversimplify, or you think you found the world formula and you use a model for purposes the model was never meant to do. However, it only means you have to do proper modeling. You have to be aware of the caveats, you have to be aware of the shortcomings of your model, and don't overstretch your statistical assumptions and the data. So this is just a warning. We're using statistics here, well, not really here in this lecture, but later on. And if you become a risk manager, you will use statistics, so you need data and you need models. Okay. However, just using statistical distributions is not really enough. You need to think about certain moments, key figures, key metrics based on a statistical distribution to measure risk. Because if I tell you I have an open position in, let's say, a corporate bond, I want you as a risk manager to give me one single dollar figure. Just tell me what the risk is. If I'm the CEO, I want my risk manager to tell me what is the risk I'm exposed to. I don't want you to babble about, well, we have used this statistical distribution and we can model the risk, blah, blah, blah. I need a number. And this number has to come out of the statistical model we are using. So the easiest way is to use some key statistics, moments, quantiles, figures, maybe even single values of your distributional model. Easiest example is the expected value. You have a distribution, you take the average, then you have an average loss. Turns out that's too pessimistic, that's too conservative. If I say, for example, well, I have an investment, my investment is 1 million, well, I could lose everything, so the risk is somewhere between 0 and 1 million, and the expected value is 500,000, that's over pessimistic. That's probably not what's going to happen. If I simply assume I'll take a maximum loss, a single value, the most extreme point of the distribution, that's like saying, well, in the long run, we are all dead. That's also too pessimistic. Telling that, okay, I could lose everything, that's not proper risk management. That's just stating the obvious. So, you will probably learn more about this if you take the class next semester on financial risk management. You will just get a few nuggets from financial risk management here. First thing we could think about is average loss, expected value. Second thing we could do is taking the variance or the standard deviation, also called volatility of the losses, or the maximum loss. I've already told you that it's not very smart to take the expected loss or to take the maximum loss. That's too pessimistic. However, volatility sounds nice. Well, it would if it were easy to interpret volatility. First of all, the variance is given in the original unit of the distribution squared. So it will be in dollars squared, in euro squared. Let's take the variance, the square root of the variance, the standard deviation, the square root of the variance, so that we have a figure in dollars or euros. Problem then is, variance or volatility measures both ups and downs. It measures variance, volatility, variation to the above and to the below, meaning that if you only have profits and if your position keeps growing and growing, volatility will be non-zero. So volatility doesn't distinguish between profits and losses, so it's not very good to use as a proxy in risk management. In financial economics, yes, stock return volatility is a proper and a frequently used proxy for risk, but that's only because stock returns usually go up and down. For some of these positions, we want to concentrate on those losses. So variance is non-negative, maximum loss expected value are not robust against extreme values. That's also a disadvantage. If you have one very extremely rare event, they will drive up or down expected loss and the maximum loss. So what you do is valued risk. Valued risk is probably the most famous risk metric there is. And I'll give you a little bit of historical context. What happened was, back in the 90s, I think JP Morgan came up with a product they called Credit Metrics. It was a computer program with which you could estimate some metrics for your credit portfolio, just like the name suggests. And Credit Metrics, inside its black box, used the valued risk. They called it valued risk, and this program, Credit Metrics, became very popular with investment banks in the US, and at some point, because every bank was using Credit Metrics, and all the banks shifted to using and calculating valued risk, regulators said, well, if every bank is using it anyway, let's make it official. Let's force all banks to report the valued risk. Seems to be industry standard and seems to be a pretty good risk metric. In Germany, it was included in Grundsatz 1. It was incorporated into the solvency regulation, the Solvabilitätsverordnung. You will find valued risk in almost all national and international regulatory documents on banking and even insurance companies. So, because regulators accepted valued risk and at some point even started to call for valued risk estimates, it went from industry standard to supervisory and regulatory standard. Very interesting story. Maybe not for you, but at least for me. So, valued risk, we haven't talked about what valued risk is. I'll show you in a bit. There is one disadvantage to it, and I will explain this to you. Valued risk is not coherent. And in a couple of slides, you will learn what a coherent risk measure is. So what is valued risk? We'll look at a portfolio of risky investments, or just at one investment, doesn't matter. And FL is the loss distribution. It's just the cumulative distribution function of L being a random variable. So the probability that their losses are smaller or equal than small l. Now that's the distribution function. Nothing new. What is valued risk then? Leave this. Let this be. I will give you the exact definition, which might be a little bit cryptic to you. What is valued risk? It's the alpha percent quantile of the loss distribution, or the alpha percent quantile of the profit and loss distribution, or the 1 minus alpha percent quantile of the loss distribution. That's the exact mathematical definition, which it turns out is a quantile. So what is a quantile? If you have a distribution that looks like this. Let's assume this is 0. This is your distribution. This is supposed to be a profit and loss, a P&L distribution. Why a P&L distribution? Because you have losses on the left-hand side and profits on the right-hand side. What is the alpha percent quantile? It's the point on the x-axis, you should know this from your statistics class, for example here, such that this here, this space is alpha percent probability, and this here as 1 minus alpha percent. It separates alpha from 1 minus alpha probability mass. So this point here on the x-axis, this here, that's the alpha percent valued risk. I hope you can read this. Could be, for example, minus 2,000 euros. Could be minus 2,530 euros. It's a loss. What does it mean? It's the loss for which there is exactly an alpha percent probability that you will incur a loss that is larger than 2,500 euros maybe. And with a probability of 1 minus alpha, you will incur a profit or a loss that is higher. Always be careful with things like a loss that is larger, a loss that is lower. I mean that with probability alpha, you have a profit or loss that is on the left-hand side of the VAR, and with 1 minus alpha, you're on the right-hand side. No? If I had a loss distribution, the loss distribution would look like this. Where's my cursor? Here. It would look like this. And then, of course, the valued risk would be here, and you would have alpha here and 1 minus alpha here. Okay, this, I mean alpha. It separates alpha and 1 minus alpha probability mass. And you will find a lot of wrong definitions in the literature. And actually, I think this is, it's not, mathematically speaking, it's not fully correct. Always be careful when you see something with maximum loss. The problem is that, yes, you can interpret it in a slightly different way as a maximum loss. However, the probability that you will incur a loss that is more detrimental than the VAR, this probability is always alpha percent. It is not 0 to alpha, but it is always alpha percent. Many bankers before the financial crisis did not understand this fully. They thought that the alpha is an upper bound for the losses, so that you would never incur a loss that is higher than the VAR. That's not correct. So in this sense, it's not a maximum loss, you will always, by definition, have a loss that is even more detrimental and even more disastrous than the VAR in alpha percent. So, for example, if you look at trading days and you take the 1% VAR, that means every 100 day you get a loss that is higher than the VAR. On 99 days, you're in the clear, but one of these 100 days, you will be here. Could be here, could be here, or could be here. The VAR doesn't tell you anything about the losses that are beyond VAR. It only says that this is the point where on the left-hand side, you will have alpha percent probability. On the right-hand side, you will have 1 minus alpha percent. So this is valued risk. You can slightly adapt it. You can make a mean VAR. You can take the valued risk and subtract the expected loss. But statistically speaking, it is all the time and will always be just one quantile of the loss distribution or the P&L distribution. So statistically, this is nothing very new. It is just the interpretation that if you calculate a quantile of the loss or the P&L distribution, you get what we now call valued risk. And obviously, you don't set alpha to be 50 or 40%. You set alpha to be 1%, 0.5%, 0.05%. So you are looking at VARs that are on the extreme left side of the P&L distribution, because you want to get a lower, more or less a lower bound for the losses. Okay. Now, banks report the valued risk. They are required to do so in their communication with regulators and supervisors, but large banks also report on their valued risk, for example, by risk types in their annual report. And this is a plot, this is a graph from the risk report of Deutsche Bank in 2017, and you can see the different VARs for interest rate, credit spread, equity, foreign exchange, and commodity risk, and you see the VAR estimates in their trading portfolio. What does it mean? It means that they estimated a valued risk. Do they say, I guess it's 1%. They estimate a 1% valued risk over their whole trading portfolio in, let's say, what is it, I guess this is foreign exchange, the upmost one, in 40 million. So they expect on the next trading day to have a valued risk, let's say at 1%, of about 40 million. So they would expect every 100 days to lose, to have a loss that is higher than 40 million. Again, be careful, it's not an upper bound. They are not expecting to lose as much as 40. They only expect that the valued risk here is 30, 40 million for the trading day, and that they might incur a higher loss. So every bank reports on this. If you want to see something interesting, look at the risk report of Deutsche Bank. I used to have this on the slides. It's still in the German one, I think. In 2006, 2007, and 2008, when the financial crisis hit. In 2006, everything was peachy. They had various risk estimates, and they also showed the actual losses. They showed that, for example, they had some trading losses and profits, and on a couple of days, yes, they had losses that were higher than the valued risk. And then take the risk report of 2007, 2008. Boy, oh boy, did they hit some losses. During the financial crisis, you can see a clustering of losses that exceeded the valued risk numerous times because, well, risk models weren't adequate and they weren't made for financial crisis. Trick question: how do you measure the accuracy of, it's not a quick trick question, but how do you measure the accuracy of such a model? By doing exactly what I just told you, let's take some lines. If these are the valued risk estimates, you include your actual losses. Let's assume those are profits, and this is a profit, this is a loss. Now, in this scenario, we would have 1 and 2 VaR exceedances, meaning that on in two of these periods or days or months, we would have a loss that exceeded our valued risk estimate. Now, if we have 2 out of, say, 100, and it's a 2% VaR, everything's fine. If this happens all the time, our risk model is not adequate. And there are actually tests, statistical tests you can use to backtest. We call this backtesting, to backtest these risk models. And 2 things are always of importance. First thing, correct number. If we expect alpha% of our losses to be higher than the valued risk, then that's the number we are looking for. If, for example, we have 100 days, if it's the 5% VaR, on 5% of all days, so on 5 out of 100 days, we would expect such an exceedance. And the second thing we would like to see is no clustering. If we expect 5 days, but it looks like this, our risk model is not working properly because it is not independent over time. And the most common backtest test for those 2 properties jointly and at the same time. The correct coverage, meaning that you have the right number of VaR exceedances, and independence over time. That's valued risk. Problem is, financial mathematicians almost 25 years ago, they came up with some ideas what a risk measure should look like. And they made a list of properties risk measures should have. And one property is subadditivity. That means if you have 2 risks, 2 distributions, L1 and L2, if you add them, meaning that you form a portfolio, then the risk measure, whatever this looks like, the risk measure of your portfolio, L1 plus L2, should be less or equal than the risk metrics, the risk measures for L1 and L2 individually. Meaning what? If you have two individual investments and you form a portfolio, you should always see some diversification but no risk amplification. And a risk measure that satisfies this property is called subadditive. It's not additive, because then you would have an equation, but it's subadditive, meaning that if you add those two positions, you should see some diversification, and the result is subadditivity. Problem is, value at risk is not subadditive for all statistical distributions, not always. It is subadditive for so-called elliptical distributions, normal distribution, Stevens T distribution, but not always. And a coherent risk measure is a risk measure that is subadditive, monotonous, and positive homogeneous. Positive homogeneity means that if you have a risk L and you invest 5 times the money, you get 5 times the risk. That should be clear. You can discuss this because at some point liquidity concerns might kick in. So if, for example, you buy up the market, you invest 100 times the money, it might be that you have 150 times the risk because you cannot liquidate that position so easily. But theoretically, positive homogeneity makes sense. 5 times the investment amount, 5 times the risk. And monotony means that, for example, if on any day position A loses 5 euros and position B loses 10 euros, and it's strictly L1 or B is strictly larger than L2 or A, then the risk measure should also reflect this. We are talking about two risks, of which one is always better or always worse than the other one. Then, of course, your risk metric should also be better or worse for one of those two. That's monotony. And if you have a risk measure like value at risk that is monotonous, positive homogeneous, and subadditive, it is called coherent. It is monotonous and positively homogeneous, but it's not subadditive. Not always, not for all distributions. That is a problem. Why? Because theoretically, if you use value at risk in portfolio management, it could mean that actually diversification does not show up in your risk metric. It is not shown. If you combine investments and use certain statistical distributions, you actually end up with a higher value at risk for the portfolio than you would by simply adding up the individual VARs. And this is counterintuitive to our idea of diversification. So what to do? You can use expected shortfall. Back in 1999, everyone was using value at risk. Then Arzneider, Eber, and Heath showed that value at risk is nice, but it's not coherent. So people, especially financial mathematicians, started to think about what should we do theoretically, and can we come up with some different alternatives that are coherent, that are subadditive. And what they came up with is, I would always call it expected shortfall. You will also find this under the name tail VAR, conditional VAR, conditional value at risk, or some alternative or some variant of this. I would always call it expected shortfall. Mathematically speaking, there are slight differences between conditional VAR, tail VAR, or expected shortfall. For me, and I would consider me an economist first and a mathematician second, no one cares about this in practice. It's always expected shortfall. There are only slight differences between discrete distributions and continuous distributions, but we don't have to care about this. So what is expected shortfall? This is the correct mathematical definition. It is the quantile from alpha to 1 over the quantile function divided by 1 minus alpha. Doesn't give us any idea what this is. First observation is actually, if I take the quantile function and insert the distribution, well, in essence, I have valued risk here in the integral. And if I take the integral, you might remember from your statistics class, or if you have even taken a probability theory class, that for statistical distributions, not just for continuous distributions, but also for discrete ones, this looks pretty much like the expected value. And this actually is the way in statistics you calculate the average or the expected value of a distribution. You take the integral. It just turns out that even for discrete distributions, the integral boils down to the average, whereas in the continuous case, for a continuous distribution, this is the usual definition of an average. But we are not using the distribution or the density function, we're using a quantile function. So let's look at the special case where the random variable is continuous and finite. The expected shortfall is nothing but the conditional expected loss under the condition that the losses exceed the valued risk. It's a conditional expected value. So it's the average of the losses beyond var. Say this in German again. Might be unusual to know the English words. Es ist ein bedingter Erwartungswert. Conditional expected value ist ein bedingter Erwartungswert unter der Bedingung, also einfach der bedingte Verlust unter der Bedingung, dass die Verluste den Valued Risk überschreiten. Expected loss under the condition that you're only looking at the losses beyond var. This is a very intuitive and actually a very economic interpretation. So, yes, that's the definition, or that's the observation. Yes, this is also a definition, but let's stick to this one. Expected loss is the average of the losses beyond var. So if we are looking at a distribution, let's now look at a loss distribution. This is our loss distribution. Then, if this is var, then, oh God, what is expected loss? Expected shortfall. What is the expected shortfall? It's the average of the losses that lie in this area. So it could be that the average of these losses is maybe here. That's expected shortfall. Nice thing with expected shortfall is it is always coherent. So it has some theoretical appeal. It is always subadditive. And for valued risk, it's not a given. But for expected shortfall, it is. What is an additional economic advantage of expected shortfall? I told you that valued risk here only tells you the point at which you separate alpha from 1 minus alpha probability mass. It doesn't tell you anything about how severe the losses are that are beyond var. Expected shortfall is an average of those losses. So expected shortfall will tell you something about tail risk, extreme risk in the outer tail of the distribution. So if you're interested in, let's say, the risk you're facing on a day-to-day basis, on each trading day, you might be interested in valued risk. If you're interested in measuring the extreme tail risk of losing a lot on one of these extreme days, you would use expected shortfall. And because both of the theoretical advantage of coherency and because you can use expected shortfall to measure extreme risk, nowadays, a couple of years ago, after the financial crisis, supervisors moved in changed regulation in banking and in insurance, and nowadays they want to see valued risk and expected shortfall. Obviously for different purposes. You can use valued risk more on a day-to-day basis, whereas you need to account and calculate expected shortfall in order to be prepared for extreme adverse market scenarios. That's expected shortfall. It's coherent, okay. I've already talked about backtesting. What you do in backtesting is you take your model, and what is frequently done is you use the data available and you split your historical data, let's say, into two subsamples, 2010 until 2018. You estimate your model based on this sample, 2010, 2018, and then you compare the actual losses in this sample. This is called in-sample testing or in-sample fitting. And then you do a forecast to 2019 and maybe 2020. And then you compare the actual losses you already know about with your predictions from your model, and you do what we call outsample backtesting. You simply ask yourself, how would my model have fared if I were in 2018 right now? You can do the same in any statistical context. You can also do it with playing the lottery. You can simply say, well, I want to see my chances of winning the lottery. Simply write down a couple of numbers and compare those numbers, that's your forecast, maybe with the next draw of a lottery. And then you see, okay, I would have won the lottery, I would have lost everything, and that is out of sample backtesting. So it's a process of assessing the quality of risk model using historical data. And in the case of VaR backtesting or expected shortfall backtesting, what would you do? You would compare actual losses with your VaR and expected shortfall estimates. This is one test you could use. It's due to Peter Christopherson, who sadly died, I think, 2 years ago from the University of Toronto, and Denis Pelletier. There is also one test by Paul Kupitz, who I think still works for the Federal Reserve System. The basic idea behind the Kupitz test, KUPIEC, is simply to count the number of VaR exceedances and to compare this number with the theoretical number you would expect. So 5% VaR, 100 days, we would expect 5 exceedances. If it's the correct number, if it's too low, if it's too high, reject the model. If it's somewhere statistically between, let's say, 5, let's say between 3 and maybe 6, then you cannot reject the risk model. The Christopherson-Pelletier test looks at this as well, but it also incorporates a test of time independence over time. So you don't have VaR exceedance clusters. Okay. Questions concerning risk measures and backtesting. I've only given you this in a nutshell because this is the topic of financial risk management next semester. Any questions? Oh, okay. Then let's turn to hedging strategies. We need to identify risks, we need to measure risk, and then we need to deal with risk. If we see that we have risk exposure, for example, in our credit portfolio, we need to do something about this. So what we can do is we can avoid risk, we can diversify risk, we can transfer it, we can reduce risk, or we can simply accept it. Remember that this is not, most of the time we are looking at credit and market risk. In operational risk management, yes, we try to completely avoid risk. We don't earn any profit from the risk that our building burns down. We don't earn any profit and there is no chance attached to the risk of our IT failing. But as soon as we give out a loan, and we want to do this because we are still a bank, we have credit risk, and we are earning, or we have the chance to earn a profit because we are accepting credit risk. So risk acceptance in many cases is wanted. However, it might be that we, for some reason, our risk has grown too much. We want to reduce risk. So we reduce it, we limit it, we transfer at least some part or sell it to another market participant. If we are very good in our business, we diversify it. So we accept our risk, and because we are such a good bank and we are a good risk manager, we can diversify risk and still keep the chance, or we simply avoid it. What could be a very simple way to avoid risk in credit risk management? How can you avoid risk in your lending business? Yeah, you screen your potential borrower, and if you see that his or her default risk is too high, you tell him or her, sorry, no loan. And that's a very simple way of avoiding a risk or whatsoever. Diversification could be, don't give out loans to the same kind of people in the same town, in the same business. Diversify geographically, diversify across business sections and industry sectors. And some other way, transfer. How could you transfer or sell credit risk? Both in retail banking and maybe in wholesale banking. In retail banking, that's very simple. Happens all the time. If you have someone who's not paying interest or not paying his payment, what you do is you simply sell the contract and your claim to a company that is specialized in, for example, mortgage loans, subprime mortgage loans, and they will try to hunt down your borrower and get the money back. You know? You will probably accept a haircut. You will probably accept, let's say, a 30, 40, 50% haircut on your claim, but you're still happy that you can back 50% at least from a loan that in essence is in default. In wholesale banking, you could also take all those loans and securitize them, and just what the banks did during or before the financial crisis, just sell large loan portfolios to market investors who are willing to accept that risk. Risk reduction, risk limitation could be what? You have a loan officer or you have a branch, and you tell your employees, you can give out loans up to, let's say, 5 million, and that's your limit. Very simple way of installing a limit system, and then you can reduce risk as well. You can probably read through all those bullet points that will now follow on the slides. It's self-explanatory, and we've just talked about this. So risk avoidance, risk diversification in credit risk management, granting loans whose probability of default is statistically independent as possible, market risk, consider correlations, dependencies between individual securities. Diversification of operational risk, that's a tricky question. You'll probably not be able to diversify op risk. How could you diversify the risk that the projector falls down on your head and that the building burns down? Usually operational risks are not really correlated, and then it's difficult. Risk transfer, risk sale. For market risk, you can simply sell your securities and close your positions. Credit risk, we talked about this. Operational risk, that's actually pretty good. As soon as, for example, the university buys fire insurance, it transfers the risk to the insurance company. So in most cases, risk transfer means buying insurance or giving it to another market participant. Risk reduction, credit risks can be reduced by limiting the amount of credit lines granted. Market risk, here we have hedge transactions. What is a hedge? What is a hedge transaction or a hedge contract? Yeah?
It's used to secure a position.
What do you mean by securing? Absichern, yeah. Imagine you have bought a stock, or you have an open position, of any kind. What does hedging in this context mean? You close the position in the sense that you make it less exposed to changes in risk factors. And if you take a stock, the relevant risk factor is the stock price. So closing the position would mean, for example, making sure that you keep the current profit and that any change, any future change in the stock price doesn't change your profit. And you can do this by doing a hedge transaction, by closing the position in the sense that you do an additional contract, you buy or sell an additional financial security, financial instrument, and the combined effect will be less exposed to the risk factor. With stocks, it's very simple. If you have bought a stock, you simply buy an option on that stock as an underlying. We'll see some additional ways of doing a hedge transaction. What is a very simple way to hedge yourself against currency risk? I actually experienced this personally this year. It was very nice. I got some money in Japanese yen. I knew that I would get some money in Japanese yen, and when I flew to Japan, I just knew I don't have to care about the currency exchange rate, none whatsoever, because I know that if if the yen appreciates in value, well, I get paid more and I will spend more in euro value in Japan. If the euro appreciates in value, well, I get paid less, but I also have to pay less euros in Japan. So I was hedged. Very simple. And you can do the very same if you think, okay, you have to go, let's say, to the UK or to the United States in a certain amount of time, and you think the current currency rate is very nice and very favorable to you, just buy or sell the appropriate amount of currency, and you're hedged. This is a very layman way of hedging, of course, but you can do this by using, for example, instruments that are based and that are related to currency rates and exchange rates. So as a rule, hedging usually includes the use of financial derivatives. We'll talk about derivatives in a moment of time, but risk reduction is usually hedging using financial derivatives. And derivatives take up a lot of the balance sheet of a bank. I think I've mentioned this before. When you take Deutsche Bank, I would no longer say as an important international bank, that ship has sailed, but at least for the largest German bank. If you take Deutsche Bank and you look at the balance sheet of Deutsche Bank, almost 50% of total assets is held in financial derivatives, meaning that it's basically a huge derivatives trading institution, and this is true for most large banks in the world. They use a lot of derivatives for speculation, but most of the time also for hedging. So you can give me a definition of what a financial derivative is. Any idea? It's early in the year and late in the evening. A financial derivative is a financial instrument, very generally. It's a financial instrument whose price is derived from the price of an underlying security. Ein Wertpapier, ein Finanzinstrument, dessen Wert sich von dem Preis eines anderen Wertpapiers ableiten lässt. Deswegen also Derivat. So that's a financial derivative. Well, might be an option, might be a swap or a future or a forward. And next we'll look at a very simple way of hedging. We'll start with a one-to-one put hedge. Is everyone clear what a put is? Who does not know? Let me ask this way. Who does not know what a put option is? You don't know? Okay. There's no problem, you can say so. A put option is the right, but not the obligation to sell a certain number of underlyings. So if it's a stock put, you have the right, you can choose to sell certify a certain number of underlyings at a certain price. This certain price is called the strike. And for example, it's an OTC contract. For example, we two could enter a put contract. I want to buy a put. You have to sell it to me, or you choose to sell the put option to me. This means that, for example, we write the put option on the stock of Tesla as an underlying. Let's take Tesla. And it matures in 2 years. And it's a European put, meaning that it's a certain type of put that can only be exercised at maturity, at the end, after 2 years. American option would be that I can choose to exercise it at any point in time. Let's make it an European option. So I buy this option from you, this put, and let's say I pay 8 euros to you. And I can sell one stock of Tesla for a strike, and let's assume the strike is 250 euros. So I pay you now, let's say 6 euros. The strike is 250 euros. Current stock price is maybe at 200, I don't know. And then we have to wait 2 years. And at maturity, I have the right to the following. If I can sell the stock to you, the underlying, for 250, and the current stock price is 100, I will sell it to you for 250 because it's favorable to me. If it's the other way around, I will let the option expire. And this is a put option, so I have the right but not the obligation to sell the underlying for a strike price. A call option would be the opposite. I have the right to call the underlying, to buy it for the strike, or again, I can let the option expire. I always say that, well, this is the favorite instrument of all James Bond villains. If you ever see a Hollywood movie in which the villain tries to make a profit by forcing a stock price up and down, he or she uses options. The same, for example, in Casino Royale. The Bond villain tries to bomb a plane. He tries to crash the stock of what is supposed to be Airbus. And unfortunately, James Bond foils his plan, the stock price doesn't go down, and then the villain is on the phone and his broker tells him the put has expired. So he wasn't able to cash in. So with a put option, you're expecting, if I buy a put option, I'm expecting the price to go down. In that case, I would cash in, I would exercise the option. If I have the expectation that the stock price will go up, I will probably buy a call, because then I can fix the price I have to pay for calling the underlying at, say, K equal to 100. And I can buy it for 100 and sell it at a higher price on the spot market. And this here is a one-to-one put hedge. Let's assume I have a stock. I have bought a stock. I will then hedge my asset position of N stocks. Let's assume, again, it's Tesla, of N Tesla stocks by buying the same number of puts on the same underlying. The result is I've bought 10 stocks, or actually this is one-to-one. Let's say I've one stock. So in the end, I get what? My position looks like this. I have one stock, I can sell it as ST, that's the spot price at maturity, so I get the stock price. I will get the put value, and I will have to pay for the put before, at time t equal to 0. The put has a payout that is the maximum of x, that's the strike, minus the stock price, or 0. And if I combine it then, ST plus the maximum of x minus ST, or 0 plus P0, I can see that the resulting payout is x minus P0, or ST minus P0. What does it mean? Well, in this case, you can see that if you have a stock of, say, Tesla, if it goes up, the value of the put will go down, and if the stock goes down, the put will go up. So The result will be of the hedged position that every euro, more or less, every euro you win with the stock, you will lose with the option, and vice versa. And this is what it looks like. If the stock price goes up, well, trivially, the value of your stock investment goes up by exactly this amount. The put option, sorry for the German language here, Verkaufsoption, that's a put option. The put option will only profit if the stock price goes down. So if you combine it, what you get is this position here. That's your hedged position. If the stock goes up, you will still profit from the stock investment. But if the stock goes down, you will be compensated via the put option contract. And this looks nice. We don't have the danger of losing everything on the stock investment because our losses are bounded by the put contract, and we can still profit from increases in the stock price. Problem is, of course, we have to pay a price. If the stock goes up and up and up, we will not profit as much from this increase in the stock price as we would have without the put contract, because we still lose some money and we have to pay a price. Just like in our example, I had to pay 6 euros to enter this put contract with you in the first place. So it costs you a little bit to get the hedging effect, but you can minimize risk. What I left out is, obviously, and you need to keep this in mind, derivative markets are always in zero net supply. And this means that it is always a zero-sum game. If we enter a put contract, if we enter any derivative contract, especially true with options, I win 1 euro, you lose it. I lose 2 euros, you gain 2 euros. No one profits. Or one party and one side profits, the other one loses. But the net position is always zero. So don't expect, if I win, you will lose, and the other way around. And for me, this is okay because I have this investment in the stock, so I will profit from the stock, I will lose in the option contract, or other way around. But you, on the other hand, as the short position in the option contract, if you don't have an investment in the stock, you can lose a lot and you can win a little bit. But you will have no hedging effect because you only have one side of this transaction, right? So in essence, if I'm a bank, if I own the stock, I use a contract to hedge. You, if you are the writer of the option, you enter a short position and you speculate. And this speculation might give you a large profit, but you can also lose a lot. So this you need to keep in mind. Options can be used and are used, of course, for speculation, but they can also be used for hedging purposes. And it depends on what you're trying to achieve. Investment banks, most of the time, will use it for speculation in their trading book. You know? So this here is obviously a hedging transaction. So this is the full profit function for the put hedge. As you can see, we have to invest S0. We have to buy the stock, let's say for 100. And if the stock stays at 100, the stock investment will give you a profit or loss of 0. If I buy it for 100 and if it stays at 100, no profit, no loss. If it goes to 150, we will win 50. If we see the stock price to go down to 0, we will lose our initial investment of S0 on the left-hand side. This is the put, this here is the put, x minus P0. And you can see that we can limit our losses. For example, if we invested 100 in the stock, the hedged position will not be minus 100, but it might simply be minus 50. So our losses are bounded below. And if you look at the right side, we will not profit as much from increases in the stock price. That's the price we have to pay for the hedging effect. Okay, so one-to-one put hedge leads to an asymmetrical gain-loss position. We get hedging effect. We are hedged against price losses, and we do not participate in full in price gains. If alternative strike prices, X, are used, you have a trade-off between increased hedging against price losses, and as you can see, with a put hedge, you can also use an American option instead of a European option. Again, an American option is an option that can be exercised at any point in time, whereas a European option can only be exercised at the very end. Okay. What are the premises of the put hedge? What are the assumptions? The assumption is that if, for example, we have an investment in Tesla stock, that there is an option written on Tesla stock. If we use an option that is written on a different stock, on a different underlying, we get what we call cross-hedge risk. We have an investment in Daimler, and we buy an option written on BMW. Same industry, different company, will not work as perfectly as we've discussed. And it might be that, there's a typo here, that you might have exercise limits. This looks nice theoretically, but in practice, a bank will be able to do this. But if you look at a medium-sized family-run enterprise, they will laugh at you if you start telling them about using options. I mean, small and medium-sized companies will never do an option contract, and they will never use financial derivatives for risk management. At least one very simple reason. The European Union. As soon as you start using financial derivatives, you fall under I think it's EMIR regulation. EMIR is a European Union directive that regulates the use of financial derivatives. And you will have to use hedge accounting, so you have to adjust your accounting, you have to adjust your balance sheet and income statement, and you will be supervised by European Union authorities in a different way than if, for example, you're just the perfume store right across the street. No one and no financial supervisor cares about you if you sell perfume, but as soon as you start using financial derivatives, they do care. And this is, together with exercise limits, this is a binding constraint here. Yeah? This is nice in theory, and banks use it all the time, and banks do this all the time, but in other industry sectors, risk management will usually be done without the use of financial derivatives. If you go to the energy sector, the large energy companies, yes, they do this and they use a lot of financial derivatives. But if you look at smaller energy companies, local energy suppliers, it's a difficult question for them. Some of the larger energy companies, like for example, the electricity companies in Munich, probably here in Leipzig as well, in the larger German cities, yes, they use financial derivatives, but it's a tricky decision for them because they know that they have the advantages of being able to do a better risk management in some, especially in energy trading, but they also know that as soon as they have one financial derivative, they fall under financial supervision of certain regulatory bodies. And then you need to weigh, you have to assess the pros and cons of engaging in derivative trading. Okay. Risk acceptance. Simply accept the risk, and you're done. So that's risk management for you. Again, if you want to learn a little bit more about risk management, you can take the class on financial risk management at the bachelor's level, and you in a probably a couple of semesters, there will also be a lecture on quantitative risk management at the master's level. Any questions concerning risk management in banking? Obviously, this is a very small discussion of risk management. No questions. Okay. Let's start a little bit with the discussion of banking regulation, and then I'll probably have to stop. We've already every now and then talked about banking regulation. And let's start very simply. Banking, financial sector, financial industry is one of the few sectors that is supervised and regulated. And in a free, competitive market economy, you should always start with the notion that no, the state should leave companies be. There is no reason at the very start why the state should interfere in a free, competitive market economy. We are not communism. So every time the state does interfere, then there needs to be a good explanation and a good justification for that. We don't want to interfere with the perfume store. The perfume store can choose whatever it wants to sell as long as it's healthy. Huh? Okay. With the financial sector, it's different. And the most common explanation for financial supervision and banking regulation is protecting customers, customer protection. That's very important in Germany when it comes to financial investments. Systemic risk and financial stability. Why? Why do you think the stability of the financial sector is of any concern to regulators? Why do you think you should justify regulation and supervision of the banking sector with financial stability? Well, because in modern economies, the financial sector, and especially the banking sector, is vital for real economy. Banks do payment, they process payment transactions, and they offer loans. They, via their lending business, banking and banks have a large influence on the real sector, on real industry. So if banks fail, we will get problems with payment transactions, and we will get problems in business loans to companies who will then stop to invest. And if payment transactions are disturbed, well, everything will fall down. If I cannot pay my rent because my bank account isn't working, I do have some severe problems, even as a private person and as a company as well. So because of the importance of the financial sector for the real sector, is usually argued that we need banking regulation and we need banking supervision. We should, as a state, as a government, we should make sure that large parts of the banking sector can never fail. We should, of course, allow individual banks to be able to fail and to default, that's okay, but as soon as one single bank failure might have a systemic effect on the whole system, we should step in. And then we get into this whole discussion of why banking supervision, why banking regulation. Do we need microprudential regulation and supervision? Do we need macroprudential supervision? Should we rescue banks? Should we bail out banks? Should we leave some banks to default? Is it good to do a bailout? And so on and so on. And we'll start with this discussion here in the theory of banking regulation. You could spend a whole semester talking about this. The theory of banking supervision. Actually, if you're more interested in this, I can only recommend to you the lectures by Professor Vollmer on financial intermediation. That's more economics related and not a business class like this one is, but Professor Vollmer presents the most important theories of financial intermediation. We've seen the diamond model here as well, but he works a little bit more into detail here. Theory of banking regulation, regulation of systemic risk, regulatory framework, leverage ratio, In Germany, we have the minimum requirements for risk management, which we call MA-Risk, Mindestanforderungen an das Risikomanagement. Minimum requirements for risk management, that is included in our financial supervision regulatory framework. Basel 1, 2, 3, probably 4, those are regulatory frameworks proposed by the Basel Committee on Banking Supervision and Regulation. The Basel Committee, as the name suggests, is located in Basel, Switzerland, which is the seat of the Bank for International Settlements, the central bank of central banks. And the Basel Committee is a committee of central bankers, supervisors and regulators who at some point thought it would be a nice idea to harmonize and standardize regulation and supervision rules across countries. And we have Basel 1, 2 and 3, and then at the end we'll talk about deposit insurance and bank runs. Also, you could spend a whole semester just talking about all the rules and regulations in banking. You will get the general idea of what is important. In many cases, what do you think? What is the core of banking regulation? In one word, capital, 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 again, capital. The simplest way and regulators' usual answer to a crisis and to problems in the financial sector is to force financial industry, to force financial institutions to increase equity or capital ratios. There is even one extreme stance. You might have heard of Martin Hellwig, who I think is now retired. He used to be a professor at the University of Bonn and the director of the Max Planck Institute on collective goods, on the research on collective good, one of the economics Max Planck Institutes in Germany. And his argument has always been simply drive up capital requirements to 50%. If it's a level playing ground, and if each bank is forced to keep 50%, we will never have a problem again. Simply force banks to keep 50% capital, then each bank is sound and safe, and it's a fair competition because every bank has to fulfill this capital requirement. It's probably not as easy as that, but what you can see is, and that's the core of Basel 1, 2, 3, every now and then supervisors and regulators increase capital ratios. And what is meant by capital ratio and minimum capital requirements is that, for example, take a very simple model of a bank. Let's assume they have total assets of $1 billion or 1 billion euros. What happens is you have profits and losses, and at some point the bank incurs high losses. So what will happen is, just like any other company, in the end, who pays? Equity holders, shareholders. So in your balance sheet, what will happen is, if you have total assets of 1 billion and let's say 10% equity, equity will decrease and decrease and decrease. And you know from basic accounting that at some point, if you run out of equity, you're bankrupt, you're default. You're in default. So what you do is, as a regulator, you have to make sure that banks have enough equity to cover losses. They should always be allowed to incur losses. You cannot think of an economy where the companies cannot earn a loss. If they do bad business, they will have to incur losses. But you have to make sure that on average, across the financial system, most of the banks, at least on average, have enough equity, have enough capital. What then follows is that regulators have argued that, well, okay, equity, maybe that's a little bit too strict. There are also some parts of debt, of liabilities, that don't need to be paid back immediately. So you have some parts of debt that will not be paid back immediately in case of default. Maybe you have some kind of hybrid financing, mezzanine financing. So what you do is, as a regulator, you tell banks, okay, take equity times 100%. Take this and this and this part of debt, maybe times a factor of 50%, plus mezzanine financing times 20%. You add this all up, and what you get is what we call regulatory capital or risk capital. Regulatory capital. Regulatory capital meaning that's the part on your balance sheet that can be used to cover losses, be it by shareholders or bondholders. And then maybe the regulators will say you have to have a capital ratio of 8%, 10%. A financial crisis hits, you see as a regulator, oh, capital ratios were too low, then drive up capital ratios to 12%. That's what is done in Basel I, Basel II, Basel III. That is done for insurance companies in Solvency I, Solvency II. That is done in the United States. In any other country, you will have capital ratios for insurance companies most of the time, banking all of the time, and that is capital requirements for you. That's capital regulation. Everything else is just a nice bonus. You prevent banks from entering certain business. You will force them to keep different liquidity ratios, leverage ratios, and so on. But in the end, it's always about capital. And capital ratios, capital requirements will be at the core of any type of banking regulation we will see in the world. And we'll talk about this in detail next week. Do you have any questions? Okay, and thank you very much, and have a nice evening.